How to tell if a stock is cheap or crazy expensive. Picture this. You open your brokerage app and see two stocks. One is trading at $10, the other at $300. Your brain immediately whispers, "Wow, that $10 one looks cheap." But here's the twist. That $300 stock could be the real bargain, and the $10 one could be insanely expensive. It feels backwards, but understanding this is one of the biggest mindset shifts in investing. We all grow up hearing buy low, sell high, but nobody explains what low actually means. Low price doesn't always equal low valuation. So in this video, we're going to fix that. By the end, you'll know how to quickly tell if a stock is a genuine deal or a trap in disguise. If you like learning about investing in a clear, no-nonsense, real talk way, hit that subscribe button now so you don't miss future breakdowns. It also tells me you want more deep dives like this, and I'll keep making them for you. All right, let's talk about what most people get completely wrong. A $5 stock is not automatically cheaper than a $500 stock. That's like saying a $20,000 car is always cheaper than a $50,000 car without knowing the brand, features, mileage, or condition. Price alone tells you almost nothing. Imagine two companies. Company A trades at $12 a share. It's barely making money, has a pile of debt, and its growth is crawling. Company B trades at $280 a share, but it's throwing off cash, growing fast, and has a strong competitive position. On the surface, $12 looks cheap and $280 looks scary. But when you look under the hood, Company B is probably the real bargain. That's how easily the market can fool you if you focus only on the sticker price. So instead of obsessing over share prices, we need to ask, what am I actually getting for this price? You're not buying a little number on a screen. You're buying a slice of a real business. To do that well, we're going to use three powerful lenses. First, the classic PE ratio. Second, a simple version of discounted cash flow, or DCF. And third, how your return really gets built over time. Let's start with the one you've probably seen before. The PE ratio, price to earnings. PE is just the stock price divided by the company's earnings per share. If a stock trades at $20 and the company earns $1 per share per year, the PE is 20. You're paying $20 for $1 of annual profit. Now imagine another stock trading at $100, but this company earns $10 per share. Its PE is 10. Even though the share price is higher, you're only paying $10 for $1 of profit. In that sense, the $100 stock is actually cheaper than the $20 one. That's the first big lesson. Share price alone is meaningless. PE gives you context. It lets you compare companies on something that actually matters. How much profit you get for the price you pay. But you can't just look at a single PE number and shout cheap or expensive. A PE of 30 might be outrageous for a slow, boring utility company, but totally reasonable, or even cheap, for a high-growth software business with years of growth ahead. So we use PE for something called relative valuation. Think of it like this. You're not just asking, what is the PE? You're asking PE compared to what? First, compare the company's current PIE to its own history. If it usually trades around 25 and now it's at 15, and nothing terrible has happened to the business, that might be a sign it's on sale. Second, compare it to direct competitors. If its main rivals trade around a PE of 30 and this one trades at 18, you might have found something interesting. Third, compare it to the overall market. If the whole market averages, say, a PE of 20 and your company is at 10, you want to know why. It could be a bargain. Or it could be broken. That's your signal to dig deeper. But relative valuation has a big weakness. Sometimes everything in a sector is expensive at the same time. During the dot-com bubble, tech stocks all looked normal, relative to each other. But the entire sector was wildly overvalued. That's where our second lens comes in. Discounted cash flow, or DCF. This sounds complicated, but the core idea is actually simple. DCF is basically asking three questions. 1. How much cash will this business generate for owners over its lifetime? 2. When will that cash show up? 3. How confident am I about those first two answers? Think about buying a local business instead of a stock. Maybe it's a coffee shop, a laundromat, or a car wash. You wouldn't stare at some random share price. You'd ask, how much profit does this place make every year, and for how long can it keep doing that? Stocks are just tiny ownership pieces of those kinds of businesses. When you think like a business buyer instead of a stock trader, everything starts to click. In a DCF, we estimate future cash flows and then discount them back to today using a required rate of return. If that fair value comes out higher than today's stock price, the stock might be cheap. If your fair value is much lower than the current price, it's probably expensive. Now, you don't need some monster spreadsheet to use this thinking. Even a rough mental DCF helps. Ask yourself simple questions. Is this company likely to grow its cash flows faster than the market for the next decade? Does it have a moat, like a strong brand, network effects, or high switching costs that protects its profits? Or is it in a brutal, commodity-like business where margins can disappear overnight? This is where quality matters a lot. A high-quality company with stable, predictable cash flows actually deserves a higher multiple. Sometimes the stock that looks expensive with a high PE is the better deal because its cash flows are far more reliable and durable. So now we have two lenses: PE and relative valuation, plus intrinsic value through DCF thinking. Let's add the third piece: how your return actually gets built. Your long-term return from a stock comes from three places: earnings growth, dividends, and changes in the valuation multiple. Say a company grows its earnings 8% per year. It pays a 2% dividend, and the PE stays roughly the same over time. In that case, you might expect around a 10% annual return. But if you buy when the PE is extremely high and later it simply drifts back down to normal, that shrinking multiple subtracts from your return. You can have a great company, solid growth, and still get weak returns because you overpaid at the start. On the flip side, if you buy a strong business when its PE is depressed, maybe because of temporary bad news or market panic, and it eventually moves back toward its historical average, that expanding multiple boosts your returns. That's where some of the best investments come from. That's why the sweet spot is often a wonderful company at a fair or slightly cheap price. You let earnings growth, dividends, and maybe a bit of multiple expansion all work together for you. The big mistake newer investors make is chasing stories, hype, and charts without asking, what is this business actually worth? A fantastic story with terrible economics is still a bad investment. A boring story with great cash flows can quietly make you rich. So when you look at a stock, slow down and run this simple checklist. 1. What does the PE look like versus its own history, its peers, and the market? 2. What do you realistically expect from future cash flows, and how confident are you? 3. How will your return be built from growth, dividends, and multiple changes? And finally, give yourself a margin of safety. If you think a stock is worth $100, don't rush to buy at $99. Maybe you only buy if it drops to $70 or $80. That gap protects you from being wrong on the details, because nobody predicts the future perfectly. As you start thinking this way, the market feels very different. You stop reacting to every wiggle in the stock price and start acting more like a business owner patiently waiting for good deals. Volatility becomes your friend. When prices drop below your estimate of value, it's like your favorite store announcing a sale. If you're still here, you're already ahead of most people who invest based purely on vibes and headlines. You now have a framework to ask, is this stock truly cheap or just cheap looking? If you found this helpful and want more clear, honest investing content like this, make sure you hit subscribe and stick around. We're building smarter, more confident investors here. And before you go, check the description below. I've linked some tools, resources, and products that can help you take your investing to the next level, including helpful links if you're ready to dig deeper or make your first moves.